Hey there, friend. I'm thrilled that you've decided to join me each week here on the podcast as I read through the Inventory Genius book. Now, if you're anything like me, you're going to put these principles into practice so much more quickly if you highlight, underline, and put dates beside each actionable step. So if you haven't grabbed your paper copy of the Inventory Genius book yet, I want to encourage you to head on over to sierrastockeland.com and grab your copy. I'm so excited to sign it and drop it in the mail for you. I want you to have that paper copy in front of you as you listen each week to each chapter I read. This way, as things stand out to you, as you have questions, as you have thoughts, and as you decide to take action, you can highlight, underline, and follow along in the paper copy as you listen to me read each chapter. So head on over to sierrastockeland.com, grab your copy, I'll sign it, and I'll drop it in the mail. Now back to the podcast. Hey friend, welcome to the Inventory Genius podcast, where we work together here to make you an inventory genius. We talk about profit, we talk about cash flow, and we definitely talk about your paycheck. Because at the end of the day, it's all related to your inventory. Let's go.
You cannot become an inventory genius without understanding how inventory fits on the balance sheet. Recession, pandemic, technology, entrepreneurship is a roller coaster. The businesses that last are those with a strong balance sheet. What does that look like? A strong balance sheet shows cash in the accounts, assets that are correctly accounted for, and no debt. We all know and love Dave Ramsey for the advice he gives families and individuals about becoming financially free in their personal lives. But do his teachings apply to business as well? They sure do. In fact, Dave Ramsey says debt magnifies your mistakes, kills your cash, puts your business's very survival at risk. It should be avoided at all costs. We have already talked about debt magnifying your mistakes. Remember the conversation about borrowing for relief only to find yourself in an even deeper hole? We have talked about debt killing your cash. Remember the overview of how profit can quickly be eaten up by debt payments? Now let's talk about debt putting your business's survival at risk and why a strong balance sheet is the key to weathering any economic storm. First, let's take a look at the way a balance sheet works and talk through the inventory and how it fits into the picture. At the top of the balance sheet, you will see a list of all your cash, checking accounts, saving accounts, even cash balances. Balances held in payment processors like PayPal and Stripe will also show up at the very top of the balance sheet. I'm sure you've all heard the statement, cash is king. Ever wonder what that means? You want to be king and you want to be strong, positioned well for any battle. The more cash you have, the more opportunities you can lean into, such as paying upfront for membership so you can get a discount, having cash so you can use to buy out the competitor when their unbalanced sheet gets the better of them, snatching up off-price or liquidation inventory at a moment's notice, and using that amazing buy to improve your margin. These are only a few things cash can do for you. Have you ever thought to yourself that people with money always make more money? It is because of cash. When you are not strapped for cash, possibilities for making more will always be available. Next on the balance sheet would be any asset you own. Assets are things that add value to your company or that can be sold, such as furniture, equipment, vehicles, or intangible assets like trademarks. A common mistake business owners make is adding purchases like these to their expenses. Did you just trademark your business name? That trademark? It's an asset. Add it to the balance sheet. Did you purchase a new point of sale system? Make sure you put it on the balance sheet instead of turning it in as a receipt and expensing it out on that month's P&L. On the balance sheet, you will find accounts receivable if you carry those in your business. Accounts receivable is essentially cash that's owed to you by someone else. Since it is something you will turn into cash, it's an asset. Anything you own or is payable to you should be an asset section. Finally, there's inventory. Remember when we talked about Jane and how her accountant had misrepresented her margin? The reason I knew to head right on over to the balance sheet is because so many bookkeepers do this with inventory. We may never know if this is due to laziness, misunderstanding, or for some other strange reason, But it is common for me to see a client's bookkeeper expensing inventory purchases instead of taking the time to enter that inventory onto the balance sheet first, and then expense it out as it sells. As a product-based business, your inventory is most likely to be your biggest asset, unless you have mountains of cash or large equipment. As such, it's imperative that your inventory is represented accurately on your balance sheet. May I rewrite that sentence and highlight it in bold? As a product-based business, it is imperative that your inventory is represented accurately and is on your balance sheet. When an inventory purchase is made, that receipt's first stop is the balance sheet. Accurately record that total value of the inventory, and as you make your monthly entries, subtract the cost of goods sold from your total inventory asset. Finally, move that cost of goods sold over to the profit and loss statement under the total sales for the month. This simple accounting practice will ensure that your inventory value is always accurately listed on your balance sheet and that your margin is always represented properly on your P&L. Let's make our way down to the liability section of the balance sheet. Credit card balances, payable loans and accounts, owed sales tax, outstanding gift cards, these are all things you owe to someone else, and they live in the liability section of the balance sheet. A strong balance sheet is heavy in assets, lean in liabilities. With this, you can make good choices, seize opportunities, and survive when times are slow or legal bills are mounting. The bankers came to do a final walkthrough of our home before we handed over the keys. Looking back, I can see that this is definitely not standard practice, but they were angry, and I guess we all do strange things when we feel vengeance is ours to take. I told my husband I couldn't show up for that appointment. I had been answering calls from collectors for months. Communicating honestly was so important to me. If I could come out of this with at least my reputation, I would feel that it was some sort of warped win. I did a lot of very hard things in the months between the first franchisee exit and closing the doors to the last store. But I simply couldn't face those bankers walking through the house, opening cupboard doors, inspecting every inch of where we had been living. I was too exhausted, and it was too humiliating. There are two things that my amazing husband did alone during that horrible season of my business life. He took our wedding rings to the pawn shop, and he walked through our home with the bankers. Remember, just a little over 2 years before, I had been on a plane to the White House and had been accepting awards and accolades from national associations. And now we were filing for bankruptcy and losing our home. We had a weak balance sheet. I want you to reread the 3 paragraphs above. Then I want you to read them one more time. I never thought this would happen to me, and I never want it to happen to you. I am recording this part of my story here because I want to jar you awake. I want to shock you into realizing you have to stop playing store with your business. Building a strong balance sheet isn't just a suggestion or an idea to consider. It is crucial that you start working tirelessly today on building a strong balance sheet. You don't know what is around the corner, a pandemic, a recession, or a mountain of legal bills. And when that storm decides to roll in, it might be too late if you have not been preparing. You need to start now if you want to reserve cash, an accurate recording of what you own, and you want no debt. With a strong balance sheet, unforeseen circumstances of any kind, while uncomfortable, won't sink you because you will have built a strong foundation.
Hey friend, thank you so much for tuning in today to the Inventory Genius podcast. If there's something that you heard today on the podcast episode and you want to dig deeper into becoming an inventory genius yourself, I want to invite you to head on over to my website, sierrastocklin.com, where I have multiple ways that you and I can work together on your inventory. I want to help you with your profit, your cash flow, and your paycheck, because at the end of the day, it's all related to your inventory. So head on over to the website, connect with me. I'll work with you soon. See you then. Hey there, friend. So I've already invited you to grab your copy of the Inventory Genius book. But if you're ready to go a step further and dive in, if you want a quick start to becoming an inventory genius, then I want to also invite you to grab your seat and the Quick Start to Inventory Genius course. This really easy to digest course is going to include all the tools, spreadsheets, and systems you need to implement the Inventory Genius method immediately in your business. We'll talk about creating an open to buy plan. We'll talk about creating a profit plan. We'll talk about creating a business budget. And then we cap it all off with a private one-on-one call, you and me. Yep, that's right. The Quick Start to Inventory Genius course includes a one-on-one coaching call with me. So you can go through the book, you can go through the Quick Start to Inventory Genius course, you can write down your questions, and then you and I can get on the phone and problem solve together. Head on over to sierrastocklin.com, grab your seat at the Quick Start to Inventory Genius course. See you there.